Is the market too expensive? What the S&P 500's forward P/E is telling us, Q1 2026 earnings season just wrapped up, and by almost every measure it was spectacular. 84% of S&P 500 companies beat earnings estimates. Blended earnings growth came in at nearly 28% year over year, one of the best quarters in years, and the market rallied. The S&P 500 just posted its sixth straight winning week, closing near 7,400, so everything is great, right? Maybe. But here's what the headlines aren't telling you. The S&P 500 is now trading at roughly 21 times forward earnings. That's above the 5-year average of about 19.5, and well above the 10-year average of around 18. In plain English, investors are paying a historically high price for every dollar of expected profit. In this video, we're going to explain exactly what forward P/E means, why beating earnings estimates doesn't automatically mean stocks are cheap, what history says about a 21x market, and what, if anything, a regular investor holding index funds should actually do about it. Let's get into it. Let's start with context. Q1 2026 earnings season is essentially finished. About 89% of S&P 500 companies have reported. Here's the scorecard. 84% of companies beat earnings per share estimates. That's above the 5-year average of 78%. Blended earnings growth, meaning actual reported results combined with estimates for companies that haven't reported yet, is running at plus 27.7% year over year. The sectors leading that growth are information technology, communication services, and financials. So by the traditional box score, this was a great quarter. But here's the thing about earnings season that most retail investors don't know. The game starts before the first company reports a single number. In the 90 days before earnings season, Wall Street analysts lowered their Q1 estimates by about 4.6%. So when companies then beat those reduced expectations, the beat rate looks great, but part of that is because the bar was set lower. It's a bit like a teacher grading on a curve. The class looks smarter on paper, but the underlying performance is what it is. Revenue beats, which don't have the same lowering the bar dynamic, were more modest. 62% beat revenue estimates, barely above the 5-year average of 61. That's telling you the earnings beats are coming more from cost cuts and margin improvements than from companies actually selling a lot more. None of this means the quarter was bad. It wasn't. But it does mean we need to put the big headline numbers in perspective before we decide what to think about a market trading at 21x forward earnings. Now let's get into the 3 things that actually matter here. The price-to-earnings ratio is simply how much investors are paying for each dollar of profit. A forward P/E uses next year's expected earnings instead of last year's reported ones, which makes it a forward-looking measure. At 21x, the market is saying, for every dollar in earnings companies are expected to generate over the next 12 months, investors are willing to pay $21 today. Is that high? Compared to history, yes. The 10-year average forward P/E for the S&P 500 is around 17.9. The 5-year average is about 19.6. 21 is above both of those. The 25-year average is closer to 16.5. But here's what P/E doesn't tell you: whether the earnings expectations baked into that multiple are accurate. If analysts are projecting strong earnings growth and those projections are right, a 21x multiple could be completely justified. If analysts are too optimistic and earnings disappoint, as they sometimes do, then 21x could be the setup for a painful correction. This is why valuation is more of a risk tool than a timing tool. A high P/E doesn't tell you when the market will pull back. It tells you there's less margin for error. The S&P 500 has traded above 20x forward P/E a handful of times in modern history. In the late 1990s tech bubble, it reached 24x before the crash. After COVID, in 2020 and 2021, it ran above 21x while the Fed held rates near zero and then corrected roughly 19% in 2022 when rates rose and the earnings outlook clouded. Right now, earnings are growing strongly. That's real. But the Fed funds rate is still at 3.5 to 3.75%, well above the near-zero levels that helped sustain high multiples in 2020 and 2021. That means investors are paying 21x forward earnings in an environment where bonds are actually paying a competitive return. That's the key tension in this market right now. Not every part of the market is equally priced. Within the S&P 500 right now, valuations vary significantly by sector. Information technology is the most expensive, trading at roughly 28 times forward earnings. That reflects the AI investment theme and the dominance of mega-cap tech companies, Microsoft, Nvidia, Apple, Meta, which collectively make up a huge share of the index. Energy is the cheapest sector at around 12 times forward earnings. Energy stocks benefit from elevated oil prices due to ongoing geopolitical disruptions, but the market is pricing in lower long-term oil prices, which keeps the multiple depressed. Healthcare trades at about 17 times, roughly in line with historical averages for the sector, and is one of the more attractively valued parts of the market on a relative basis. For a retail investor holding the S&P 500 index, this matters because you own all of these sectors. Your index fund is expensive at the headline level, but that's partly because technology, the largest sector by weight, is expensive. The overall index reading of 21x is being pulled up by a small number of very large, very pricey companies. Let's take a look at what the charts are actually telling us. The S&P 500 is sitting near 7,400, just below the all-time high zone around 7,450. The 50-day moving average is around 7,150, and the 200-day moving average is near 6,820. The chart shows the index trading well above both moving averages. That's a bullish technical structure. The level to watch on the upside is the 7,450 resistance zone. A clean break above that opens the door towards 7,600 or higher. On the downside, the first meaningful support is that 50-day moving average near 7,150, roughly a 3% pullback from current levels. A break below that would start to raise questions about the near-term trend. The Nasdaq Composite is around 23,200 after a strong week, up about 4.5% in the week of May 4th through 9. The chart shows it back above its 50-day moving average after spending time below it in early April. Key support to watch is 22,000. That's where buyers stepped in strongly earlier this year. Resistance is around 24,000. On the sector rotation front, the divergence this year is notable. Energy is the top-performing sector, up about 14% year-to-date, driven by elevated crude oil prices from ongoing geopolitical supply disruptions. Consumer discretionary is the laggard, down roughly 3% year-to-date, reflecting caution about consumer spending, holding up amid still elevated prices. For investors tracking sector exposure in their portfolios, the chart shows money moving toward defensive and commodity-linked sectors and away from consumer-facing ones, a pattern that tends to show up when investors are growing more cautious about the economic outlook, even if the headline index is still near highs. So what do you actually do with all of this? Here are 3 practical takeaways. None of these are investment recommendations. These are simply frameworks for understanding what a 21x market means for a regular investor. Here's the bottom line. Q1 2026 earnings were genuinely strong, and the market rally that followed reflects real underlying profit growth. But a 21 times forward P/E means investors are paying a premium, and historically, premium-priced markets require everything to go right to keep delivering strong returns. That's not a reason to panic. It's a reason to stay informed, stay diversified, and understand what you own. If this video helped you understand valuation a little better, Drop a comment below. I'd love to hear what you're watching in your own portfolio. And if you want weekly breakdowns like this one delivered every time the data moves, hit subscribe. I'll see you in the next one. This video is for educational purposes only and does not constitute financial advice. Always consult a licensed financial advisor before making any investment decisions.